Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Absolutely.
Well, here we are again, Tuesday, April 1st, 2025.
April Fool's Day.
April Fool's Day. You got it. And boy, are we drowning in financial news right now. But
Right.
don't worry, you don't have to sift through it all because we've done it for you.
That's right.
We've been digging deep into the top headlines from sources like MarketWatch and Bloomberg, and we're ready to break it down for you.
Exactly.
We don't just want to throw the headlines at you, though.
Nope.
Our goal is to go deeper and pull out those key insights to help you make sense of it all.
Definitely, because it's about connecting the dots between all these different events and seeing the bigger picture.
Exactly. And today, there's some pretty major themes we're seeing pop up.
Oh, yeah.
First, gold is absolutely on fire, hitting record highs.
Yeah.
But could there be a correction coming?
Right.
Then we have electric vehicles, a sector with Tesla facing some hurdles, while BYD is absolutely taking off. And, of course, we can't forget about crypto, which always seems to be on a roller coaster ride.
Never a dull moment there.
Never. And then looming over all of this is the uncertainty surrounding the tariffs that President Trump is expected to announce.
Exactly. That's the big one. And it's having a ripple effect across the market.
It really is. Okay, so let's jump right in. And I think a good place to start is with this incredible surge in gold prices.
Makes sense. Gold's been the hot topic lately.
It really has. MarketWatch has a piece titled, "Another Day, Another Record High for Gold." And they're not kidding. The precious metal hit a record settlement high on COMEX Monday, reaching $3,150.30 an ounce.
Wow.
The June contract also settled at that same record, climbing by $36 or 1.2%.
So it's not slowing down.
Not at all. And what's even more remarkable is the sheer momentum behind this rally. MarketWatch points out that gold was up a hefty 10.6% just in March, and for the entire first quarter, an astonishing 19.3%,
Wow, that's incredible.
the largest quarterly gain since way back in 1975.
Wow, 1975. That's a long time ago.
It really is. Makes you wonder if we're seeing some of the same economic anxieties resurfacing today.
It does make you think, doesn't it? I mean, what parallels do you see there?
Well, it's interesting, both MarketWatch and Bloomberg, in their piece titled "Gold XAUSD Hits Fresh Record as Trump's Looming Levies Boost Havens," point to the same driver behind this gold rush. And that's uncertainty.
Right.
MarketWatch talks about this fear premium in their article.
Fear premium. What's that all about?
Well, it basically means that when investors get nervous about riskier assets like stocks, they're willing to pay more for safe haven assets like gold.
Makes sense. So the fear drives up the price.
Exactly. And Bloomberg explicitly links this surge in gold prices to concerns about the global economy and a flight to safety driven by those anticipated tariffs that we talked about.
So it's a double whammy for gold right now, a combination of stock market jitters and geopolitical uncertainty.
You got it. And then you have Will Rind from Granite Shares. He's quoted in the MarketWatch piece. And he goes so far as to say that gold is becoming the defector hedge against the U.S. dollar.
That's a powerful statement.
It is. It suggests a real lack of confidence in the traditional safe haven currency.
Yeah, if people are moving away from the dollar, that's a big deal.
It is. And Bloomberg backed this up. They say gold is on track for its fourth straight day of gains as traders anxiously wait for more details on the tariffs, which are expected to be announced on Wednesday.
Wednesday, that's coming up fast.
It is. And Bloomberg also emphasizes that this isn't just a short-term spike. Gold has had its best quarter since 1986. So this is a sustained rally.
Wow, that's pretty remarkable.
It is. And they say it's being fueled by this huge surge in safe haven demand, but also consistent buying from central banks and broader macroeconomic uncertainties.
So there are multiple factors at play here.
Absolutely. It's not just one thing. And what I found really interesting is that Bloomberg points out that holdings in gold-backed ETFs have risen by over 6% in 2025.
Gold-backed ETFs.
Yeah, those exchange-traded funds that invest in physical gold.
Right, right.
And those holdings are now at their highest levels since September 2023.
So that means more and more investors are looking to gold as a safe haven.
Exactly. It's not just speculative trading. This seems like a broader embrace of gold as a safe asset.
Interesting. So with gold prices reaching these record highs, the question on everyone's mind is this sustainable or is a pullback inevitable?
Right. Is this the peak or is there more room to run?
Exactly. And MarketWatch brings in Fawad Razakzada from City Index and 4rx.com to weigh in on this.
He seems to think the profit taking is very likely above $3,000.
Yeah.
And we've clearly blown past that threshold.
So he's saying people might start cashing in on their gains.
Exactly. And he even uses the term rug pull to describe what could happen.
Rug pull.
Yeah, kind of a slang term for a sudden and sharp downward correction.
Ouch, that doesn't sound good.
It doesn't. And Razagada goes on to outline some potential triggers for this pullback.
Like what?
Well, he says a break below the $3,057 to $3,066 support level could be a short-term signal.
So that's a level to watch.
Definitely. And he says for a more significant drop, we need to see gold fall below $3,000.
So those are the key levels to keep an eye on.
Exactly. But then we have Will Rhine from Granite Shares, who offers a different perspective in the MarketWatch article.
Oh, really? What does he say?
He suggests that these reciprocal tariffs that are set to take effect on Wednesday could actually turn out to be a buy-the-news event for stocks.
Buy the news meaning?
Meaning that once the news is out and the tariffs are actually in place, the market might react positively and stocks could go up.
Interesting. So he's saying the anticipation might be worse than the reality.
Exactly. And if that happens, it could lead to a shift away from safe havens like gold and back into risk assets.
So gold could actually pull back if stocks start rallying.
That's his thinking, and it's an interesting counterpoint to the rug pull scenario.
It is. It shows that the market doesn't always react in a predictable way.
Right, and just to add another layer of complexity, Bloomberg mentions that analysts at both Morgan Stanley and Goldman Sachs are actually forecasting further price increases for gold potentially reaching $3,300 to $3,400 by the end of the year.
So we have some experts predicting a pullback and others predicting even higher prices.
It's a real tug of war.
It is, and it puts you, the listener, in a tough spot trying to figure out who to believe.
Right. Is the fear surrounding these tariffs and the overall economic uncertainty going to be enough to push gold even higher?
Or will the potential for a stock market rebound and profit-taking finally bring this rally to an end?
I guess we'll have to wait and see how things unfold, especially after those tariff announcements on Wednesday.
Definitely Wednesday is going to be a key day.
All right, let's shift gears now and talk about electric vehicles, because there's a fascinating story playing out there with two major players, BYD and Tesla.
Oh, yeah. The EV market is always interesting. Things change so quickly.
They really do. And as Bloomberg puts it in their headline, BYD enjoys yet another blockbuster quarter as Tesla flounders. The contrast between these two companies is striking.
Yeah, I saw that headline. So what's going on with BYD?
Well, according to Bloomberg, their sales surged by an impressive 58% in the first quarter of 2025 compared to last year.
Wow, 58%? That's huge.
It is. They delivered a total of 986,098 passenger vehicles in the first 3 months of the year. And of that, 416,388 were pure EVs.
So they're really dominating the electric vehicle space.
They are, and it's important to remember that BYD stopped making combustion engine vehicles back in 2022, so they're all in on electric and hybrid.
Right. They went all electric early on.
They did, and then you look at Tesla, and some analysts are estimating that their Q1 sales might be as low as 340,000 or around 377,000.
That's a pretty big difference.
It is. It seems like BYD is leaving Tesla in the dust, at least for now.
So what's behind BYD's success and Tesla's struggles?
Yeah, there are a few things going on. It seems Bloomberg suggests that Elon Musk's political activities are starting to hurt the Tesla brand.
Really?
Yeah, they say it's leading to sales declines in key markets like Europe and the U.S.
Interesting.
And MarketWatch has an article titled, Tesla sales fell by nearly 40% in France in March, which really highlights this trend.
What does the article say?
Well, they report that Tesla sales in France dropped by 37% in March, and they're down a whopping 41% for the year so far.
That's a significant drop.
It is. And they also mentioned that Tesla sales plunged by 64% in Sweden in March. So it's not just France. It seems to be a broader European trend.
So Tesla is facing some headwinds in Europe.
Definitely. And Bloomberg points out that the intense competition from domestic manufacturers like BYD is a major factor in Tesla's challenges in China.
Right. BYD is a Chinese company.
Exactly. So they have a home field advantage there.
Makes sense.
And the MarketWatch article sort of hints that Musk's political leanings might be alienating some buyers.
That's a possibility. It's hard to say for sure, but it's definitely something to consider.
It is. And then when you look at what BYD is doing right, it seems like they've been very successful at generating buzz around their new products.
Oh, yeah. I've heard some good things about their new models. What are they doing differently?
Well, for one thing, Bloomberg reports that they're offering free smart driving technology on most of their new models.
Free smart driving technology, that's a pretty big selling point.
It is. And they've also introduced an ultra-fast charging system that can add 400 kilometers of range in just 5 minutes.
5 minutes, that's amazing.
It is. It seems like they're really focused on innovation and convenience.
And that seems to be resonating with consumers.
It does, and the stock market is reflecting this difference in performance, too.
How so?
Well, Bloomberg reports that BYD shares have soared by about 45% this year, while Tesla's have plummeted by 36%.
Wow, that's a huge divergence.
It shows how investor sentiment can shift quickly.
And what about BYD's plans for the future? Are they looking to expand?
Oh, absolutely. They're very ambitious.
Yeah.
Bloomberg says they're aiming for around 5.5 million vehicle sales this year.
5.5 million, that's a lot of cars.
It is, and they want to export about 800,000 of those.
Even with the tariffs.
Even with the tariffs. Which is interesting because Bloomberg points out that BYD doesn't currently sell its passenger cars in the U.S. due to the high tariffs and the ban on their smart driving technology.
So the tariffs are already having an impact on the EV market.
They are, and it'll be interesting to see how things change once those new tariffs are announced.
It will. And on a financial note, Bloomberg highlights that BYD has reported record net income and full-year revenue exceeding $100 billion, actually surpassing Tesla in this key financial metric.
That's a major milestone.
It shows that BYD is a force to be reckoned with in the global EV market.
All right, let's move on to the world of cryptocurrency now, because it seems like there's always something happening there.
Always something happening in crypto, that's for sure.
And this time, it's not good news. Bloomberg's headline says it all. Coinbase Coin sees worst quarter since FTX fell as crypto slides.
Coinbase, that's a big cryptocurrency exchange.
It is, and their shares plummeted by 31% in the first quarter, their worst performance since the collapse of FTX.
Wow, 31%, that's a big hit.
It is, and Bloomberg points out that other crypto-linked stocks like Galaxy Digital Riot Platforms and Core Scientific also suffered significant declines.
So it's a broad crypto downturn.
It is, and Bitcoin itself tumbled by over 10% during the quarter, while Ether, another major cryptocurrency, lost a whopping 45% of its value.
Yikes. So what's causing this crypto crash?
Well, Bloomberg says it's mainly due to growing concerns about the U.S. economy fueled by President Trump's escalating trade war.
So the same tariffs that are boosting gold are hurting crypto.
It seems that way investors are getting nervous and pulling out of riskier assets like cryptocurrency.
So it's a flight to safety, but away from crypto.
Exactly. And Owen Lau, an analyst at Oppenheimer, is quoted in the Bloomberg article. And he believes that this downturn is primarily driven by these macroeconomic factors. You know, the tariffs, the potential trade war, and the increasing worries about a recession.
So he's saying it's not about fundamental problems with crypto itself.
Exactly. He thinks it's more about the overall economic climate.
That makes sense.
And it's interesting because we were just talking about how gold is considered a safe haven asset.
Right, the defector hedge.
Exactly. And some people have argued that Bitcoin should be seen as digital gold, you know, a hedge against traditional market turmoil.
So is Bitcoin living up to that reputation?
Well, not really, at least not right now. Bloomberg points out that actual gold has had its best quarter since 1986, precisely because of this safe haven status amidst all the uncertainty.
So the market is clearly making a distinction between gold and Bitcoin.
It is, and Bloomberg also highlights that the initial post-election optimism that had briefly boosted the crypto market has faded.
Yeah, I remember there was a lot of excitement after the election.
Bitcoin even hit a record high, but then it started declining after President Trump announced the creation of a strategic reserve of cryptocurrency.
A strategic reserve?
Yeah, but without allocating any taxpayer funds for its expansion. So it was kind of a mixed message.
I see. So the initial enthusiasm fizzled out.
It did. And for Coinbase specifically, their business model is heavily reliant on trading volumes across various cryptocurrencies, including Ether, which took that big hit.
So when trading activity drops, the revenue takes a hit.
Exactly. And Bloomberg reports that analysts believe the crypto market needs new catalysts to reignite investor interest.
New catalysts, like what?
Well, maybe new technological developments,
Yeah.
regulatory clarity, or even just a more positive economic outlook, something to get people excited about crypto again.
So the market is kind of in a wait-and-see mode.
It seems that way. But amidst this broader crypto downturn, there's one company that's making a bold move. Michael Saylor's company Strategy.
What are they up to?
Bloomberg reports that they just made their biggest Bitcoin purchase of the year.
Really?
Yeah, they spent $1.9 billion on 22,048 Bitcoins between March 24th and 30th.
Wow, that's a lot of Bitcoin.
It is. They bought it at an average price of around $86,969 per coin, and this brings their total holdings to approximately $43.4 billion, which is about 2.5% of the entire circulating supply of Bitcoin.
That's incredible. They're really betting big on Bitcoin.
They are. It shows a strong belief in its long-term potential.
And how are they financing these massive purchases?
Bloomberg says they're using the proceeds from at-the-market sales of their common stock and offerings of preferred shares. So they're basically raising capital to buy more Bitcoin.
And has that strategy been successful for them?
Well, Bloomberg reports that Strategy's common shares have surged by an incredible 2,200% since they started investing in Bitcoin back in 2020.
2,200%. That's amazing.
It is, and during that same period, Bitcoin itself is up over 600%.
So it seems like their bet is paying off.
So far, so good, but it's a risky strategy for sure.
Definitely not for the faint of heart.
All right, let's zoom out now and talk about the broader market sentiment, because there's a lot of anxiety out there.
Yeah, with all this talk of tariffs and economic uncertainty, it's understandable that investors are nervous.
MarketWatch sums it up well in their headline. Investors' jitters climb an ugly quarter for S&P 500.
Ugly quarter. What happened?
Well, the S&P 500 had its worst quarterly performance since 2022, dropping by 4.6%.
So the market is definitely feeling the pressure.
It is, and investors are worried about the potential impact of those reciprocal tariffs and the possibility of stagflation.
Stagflation, that's a scary word.
It is. It means we could see slow economic growth combined with high inflation.
That's a tough combination.
It is. And the SIBO Volatility Index, or VIX, which measures expected stock market volatility, has been climbing as well.
The VIX is also known as the fear gauge, right?
Exactly. And MarketWatch reports that it jumped by about 28% in the first quarter, its biggest quarterly surge since last September. So investors are definitely on edge.
So the fear is palpable.
It is, and Macquarie strategists are quoted in the MarketWatch article, and they make an important point. They say that unlike the tariffs back in 2018, these 2025 tariffs are happening against a backdrop of rising inflation expectations.
So the economic context is different this time.
It is, and they call this a stagflationary dissonance, which basically means it's a tricky situation for the Federal Reserve.
How so?
Well, the Fed is trying to keep inflation under control, but these tariffs could actually make inflation worse.
So it's a dilemma for them.
It is, and MarketWatch reminds us that inflation is still above the Fed's 2% target, and the benchmark interest rate is currently at 4.25%, 4.5%, so they have limited room to maneuver.
So the Fed is in a tough spot.
They are, and everyone is waiting to see what those reciprocal tariffs will actually look like. They're expected to be announced on April 2nd.
April 2nd, that's just tomorrow.
I know it's coming up fast, and President Trump has dubbed it Liberation Day, but no one really knows what the economic and market impact will be.
So there's a lot of uncertainty hanging over the market.
There is, and Morgan Stanley analysts have outlined a couple of possible scenarios in the MarketWatch article.
What are they?
Well, their baseline expectation is that we'll see increased tariffs on goods from China and targeted tariffs on specific products from Europe, with potential exemptions for Mexico and Canada.
So that's their base case.
It is, but they also warn of a more onerous scenario where tariffs could be higher and applied to a wider range of countries and products.
And that would obviously have a bigger impact on the market.
It would, and it's this uncertainty that's really unsettling for investors.
Makes sense. When you don't know what to expect, it's hard to plan.
Right, and this anxiety isn't just limited to the U.S. market. Bloomberg reports that European Commission President Ursula von der Leyen has said that the EU is prepared to retaliate if the U.S. imposes tariffs.
Just so we could see a trade war escalate.
It's a possibility, and that would have global repercussions.
Definitely not a good scenario for anyone.
But on a slightly more positive note, there's been some encouraging news on the European economic front.
No, what's that?
Well, Bloomberg reports that bond yields across the euro area have fallen after data showed that inflation is easing.
So inflation is cooling down in Europe.
It seems to be, which is good news for the European Central Bank. They've been trying to get inflation under control.
Right. And this could mean that they'll cut interest rates again.
Exactly. That's what the market is expecting now.
So while the U.S. is facing potential inflation from tariffs, the Eurozone might be able to ease monetary policy.
It's a sharp contrast.
It is, and it shows how interconnected the global economy is, but also how different regions can face very different challenges.
All right, before we wrap up, there are a couple of other interesting headlines that caught our eye.
Oh, yeah. What were those?
Well, Bloomberg reported that Danske Bank is lifting its investment ban on a number of defense companies.
Really? What is that?
Well, they say it's because of the changing geopolitical landscape and a greater focus on European defense capabilities.
So they're responding to the current global situation.
Exactly. And Bloomberg also had a piece on HSBC. They're saying that the bank's executives are confident about reaching their financial targets, and they're expecting strong dividends.
That's good news for HSBC shareholders.
It is, and they've been restructuring their business, and their largest shareholder, Ping An, seems to be on board with the changes.
So things are looking up for HSBC.
It seems that way. And in the tech world, there's an interesting debate brewing about whether Google might be at risk of becoming irrelevant.
Google irrelevant. That's hard to imagine.
I know, but Amelius research analyst quoted in a MarketWatch article thinks it could happen.
Really? What makes them think that?
Well, they draw a parallel to Kodak, which
Hmm.
failed to adapt to the digital photography revolution. And they suggest that younger generations are increasingly turning to AI-powered tools like ChatGPT for search.
ChatGPT, that's the chatbot that everyone's talking about.
Exactly, and the analyst says it's become like a verb for younger users while Google seems to be falling behind.
So they're saying Google could become the next Kodak.
That's the concern, and it's a reminder that even the biggest tech giants aren't immune to disruption.
It's a cautionary tale for sure.
And speaking of AI, MarketWatch reports that OpenAI, the company behind ChatGPT, just raised a ton of money in a new funding round.
How much?
Well, they raised $40 billion, which values the company at $300 billion.
$300 billion. That's more than Chevron.
It shows the incredible amount of investment flowing into the AI sector.
AI is definitely the hot space right now.
It is. And finally, Bloomberg had an update on the oil market. They're saying that oil prices have stabilized after some volatility caused by President Trump's comments on Russia.
So the oil market is in a wait-and-see mode, too.
It seems that way. Everyone's waiting for those tariff details.
And the big question mark hanging over everything right now.
It really is. So, to sum it all up, it's been a wild ride in the financial world lately.
Absolutely, with gold soaring, EV companies battling it out, crypto on a roller coaster, and those looming tariffs creating so much uncertainty.
A lot to keep track of.
It is, but hopefully our deep dive has helped you make sense of it all and given you some insights into what might be coming next.
That's our goal, and we hope you found it valuable. Well, that's all the time we have for today's deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.
See you then.